Imagine for a minute you could build a 3-fund ETF portfolio that you could literally put money into and become a millionaire over the next couple years. That is exactly what we're going to be breaking down today. A simplified portfolio that is going to be built up entirely of 3 different ETFs of your choosing. So let's go ahead and break this down. When you start building out a 3 ETF portfolio, it really starts the first part with the foundations. So overall, looking at ETF.com, we're going to be comparing 2 foundational or fundamental ETFs that we're going to be breaking down, which is the VOO versus the VTI. Looking at both of them, the VOO, of course, is the Vanguard 500 Index Fund, and the VTI is the Vanguard Total Stock Market ETF. So a little bit of a difference, but still, when you look at the big picture comparison, not only having the diversification in the market, it makes a big difference. Now, out of these 2 funds, you are going to choose one of the 2. And I did want to break down a little bit of the comparison. Now, of course, both of these are Vanguard funds. They both have the exact same expense ratio. Looking at the S&P 500, that is what tracks the S&P 500. This is the CRSP US total market. And you can see the total number of holdings is one of the biggest differences. When you look at the VOO, it is the 500 largest companies within the United States. When you look at the VTI, it is 3,685 companies that are publicly traded within the United States. So again, they are both US-based ETFs that we're looking at here. Total return, you can see, are pretty much a mere kind of 1-in-1, even though the VOO and the VTI do hold an incredibly different amount of stocks. You can see they do have a very similar run rate. Even looking at the last month, they're almost identical, about a 0.3 difference. But when you start looking at year to date, the VOO is performing a little bit better than the VTI. And even looking at the 5-year and the 10-year, we are seeing the exact same thing. So what we're thinking big picture is when you look at the largest companies within the United States, the 500 largest companies, they're a much larger driving factor than having the VTI, which does include those mid caps and those small caps on businesses. And overall, you can see very, very similar, but performance-wise, the VOO does edge ahead. Now, looking at here, you can see there is $2.45 billion in there in the VOO in comparison to $784 million, which is the trade volume that we have. So the VOO does see a much, much higher trade. Now, you also notice that with the weighted average, and that is something to notice, is when you look at the amount of companies that are within these holdings, it is really the weighted average. And you can see the VOO only focusing in 500 companies. They hold almost the identical companies. We can see Apple, we can see Microsoft, we have Amazon, Nvidia, Alphabet, Meta, and another Alphabet right there, Tesla, Berkshire Hathaway. So these are almost identical. You can see Eli Lilly actually in the VTI and JP Morgan over here in the VOO. So again, when you think publicly traded companies, they are the largest companies within the United States in the VOO. And you can also see with the market cap of the VTI, you do have a lot of kind of overlap with these 2 funds, except with the VTI, you do have the exposure with the mid cap and the small caps, like we we're kind of saying overall. Now, of course, when you start really breaking it down, you can see, again, very similar. The technology services, the VOO, a little ahead right there, as well as the electronic technology. Now, a case can be kind of made when you think of technology funds and how the technology ETFs and companies have been performing. Since the rise of AI in the last couple of years, they've done exceptionally well. Doesn't mean they're going to do well in the future. In my opinion, yes. I feel like the tech companies are going to outperform what the total market might do with the VTI fund. So in my case, I would look at holding the VOO versus the VTI. But of course, just choosing one of these are going to be the fundamental ETFs that you have in this portfolio. And then, of course, looking at the distribution, very, very similar when it comes to the yield for these 2 ETFs. So again, when you look at these 2 in the comparison between the VOO and the VTI, you are going to choose one of these as your financial or as your fundamental US ETF that you're going to choose. The second one of the 3-fund ETF portfolio is going to be your growth fund. Now, of course, this is going to be the high risk one, but it is also going to be the one that you're going to see the most growth in. So out of these, we are choosing again 2. We are doing the VUG, which is the Vanguard Growth ETF, and QQQM, the Invesco NASDAQ 100 ETF. Now, both of these are very, very heavy when it comes to the growth factor. You can see when it comes to the VUG, the Vanguard one, it does have a considerably lower expense ratio. And you can see, though, the holdings with the VUG at 209 compared to that QQQM at 102. So the VUG is holding over twice the amount of companies that we are holding in the QQQM, but let's see kind of how that stacks up. You can see both of these almost just about on par looking at the growth. QQQM as of April 29th, edging it out a little bit. And of course, we start looking at the bigger comparison. The QQQM is relatively new, so we don't have the 5-year and the 10-year. But when you look at the performance of these, again, with the assist of artificial intelligence and looking at some of the biggest companies that we've seen there, including, Alphabet, Meta, looking at Google, looking at NVIDIA, you can see in the 3 months right here, the VUG is doing incredibly well. Even looking at the year to date, again, that VUG really outperforming. Then we look at the 1 year, and this is where the QQQM actually does take a little bit of a lead. Same with the 3 year, we are seeing a little bit of a lead with the QQQM, and we think that is going to be true with the 5 year and the 10 year, that we're going to see the QQQM actually outperforming that VUG that we do have. Now, of course, looking at the holdings, even looking at the trade volume, very similar. Holdings, VUG actually holds twice what we were saying with QQQM. And of course, looking at the expense ratio, a little bit higher with QQQM, but very, very similar breakout with the companies that they hold. But QQQM is actually holding this in a very different methodology, because you can see right here, the VUG, Apple is 13%. QQQM only holds it at 8.43. So considerably different with their holdings. Even here, we're almost 13% in Microsoft. On the other side of the M, we are at 8.94. So again, that is the largest holding that we do have. Also looking at Amazon, NVIDIA, and Alphabet, again, looking at the holdings here. So it is a little bit of a different of a holding. And it's interesting to see, because when you think of the VUG and the amount of holdings, and then of course you break it into a more concentrated QQQM, it seems like the risk mitigation factor with this ETF seems to come out a little bit on top, just for the simple fact that they are not so reliant on a couple of companies. Because even when you start breaking out, 10, 20, 25% is between Apple and Microsoft. You add in a few of the next one, you're 30, 40% on some of these companies. And of course, even having a higher holder in Tesla, and then of course a little bit less over here, where Tesla's kind of been underperforming for a considerable amount of time now. It's interesting to see how these holdings break up. And again, thinking long term in the next 5 to 10 years, setting up this 3 ETF portfolio that you can carry forever. My choice in here would be the QQQM, and even kind of breaking it down with how it looks. You're not so heavily vested in technology, and still a little bit higher in the electric technology, but you can see the kind of breakdown in here in comparison. Holding a little bit of a different one, even commercial services almost completely gone, because remember, QQQ and the QQQM are really based on the technology factor. This again is our high risk, high reward ETF that we're going to be putting money into. And again, this is going to be the second piece when it comes to that 3 ETF portfolio. So definitely choosing one of these to put into those pie slices through M1 Finance, we're going to build out. And overall, I'm going to show you the portfolio at the end, exactly what we built out for here. And I'm going to show you actually both the portfolios that I do carry. So let's go ahead and take a look at our final piece. For the final piece of this ETF portfolio, we are looking at the safe, secured. These are going to be the dividend yields that we are getting in here. This, of course, if there's market downturn, these don't go up as much. If there's a lot of market growth, these don't go as high. But overall, these are the stability. These are going to be the income producers. And again, when you start reinvesting dividends, and I'm going to show you exactly how this works through M1 Finance, but when you start reinvesting the dividends, it is going to give you the ability to not only buy more of this particular ETF, but also buying the other ETFs that we chose in the category. So looking at the SCHD, which is the Schwab US Dividend Equity ETF, and the VYM, which is another Vanguard high yield dividend, you can see they run the exact same expense ratio. The VYM holds 452 companies, where the SCHD is usually around 102. But when you start looking at the performance, you can actually see that the VYM is actually outperforming the SCHD by about 2.5% right there. So we are seeing a little bit more growth out of the VYM, but of course, I'm going to show you exactly why and why they have so many more holdings when it comes to the VYM in comparison to the SCHD. Now, when we start looking at a bigger picture, year to date, you can see the performance is not as high. When you look at 1 year, again, a little bit lower. When we start looking at the 5-year and the 10-year, you can see the SCHD has outperformed the VYM. And again, I'm going to show you exactly why as we get a little bit more further into this. But overall, you can see the SCHD doing incredibly well. Now, when it comes to the trade volume, everything else very similar when it comes to the build. But looking at the build here, this is where the difference really does come in. Now, the SCHD, you can see because of them not holding as much, they actually have a much higher weight. Even looking at 5% with Broadcom right here to 3.42, and looking at some of the largest dividend payers that we have, you again will see overlap within here. Choosing one of these are going to be a very important part of this 3 ETF portfolio. So literally setting it and forgetting it. Now, the big thing is when you start coming down here, looking at the financial sector, the VYM does hold quite a bit more and quite a bit of a heavier kind of weight in there. Health technology, you can see they're pretty even. But then when you get into the dividend yield, you can see a 3.45 versus a 2.91. So the SCHD is giving you and paying a much higher dividend yield. And I believe this is even a little bit lower than they did with the rebalancing. So just based on this, it seems like out of these two, I personally like the SCHD a little bit better. VYM is going to, of course, offer a little bit of diversification, and with that can come a little bit of growth depending what it's going to be in. But overall, the basis of the SCHD, I do like the return, even looking at the 5-year and the 10-year. And when we're looking at our 3 ETF portfolio, it is really the breakout of which one you want. So as the third part of your portfolio, it is going to be important to either choose the SCHD or the VYM as the final part of our ETF. So let's hop over and see exactly what it looks like put together. All right, guys, so here is my debt-free journey portfolio. If you've seen this before, we really celebrated when we hit that 100,000 mark. And of course, this is the point where we start seeing a lot more growth. We start seeing a really big snowball. And I'm gonna show you my strategy that I did here. Now, this is kind of the 3 fund portfolio like what we talked about, but is equally weighted. But looking at the slices that we have here, we of course have our stability right here in the SCHD. We went with the Schwab US Dividend Equity. This is what I've really built. And as you've seen, since we've been putting money in here about 2.5 years, we're up a little over $1,000. You can see we have around 26,000 in this account right now. Now, when it comes to the growth fund in the high risk, high reward, I really feel like at my age, I am mid-40s, that we do need to see a considerable amount of growth. So if you look at the big 2 that we were looking at, one was the VUG and the other one was the QQQM. So looking at my allocation here between the high risk, high reward of the VUG and the QQQM, I actually went ahead with this portfolio, invested into both of them. So I did a 25% allocation. So again, when you think big picture, the final one that we had in here was the VOO, which is the Vanguard S&P 500. And in 2.5 years, you can see we're up about 56% here, which is crazy. The Vanguard Growth Fund around 56% again, which is kind of crazy. Dollar cost averaging in here. And we changed the portfolio a little bit. The QQQM was actually one that we added much later in the game. So we're only up around 12.84%. And then of course the Schwab, the US Dividend Equity Fund up 7.45. But now when you think of the composition of this portfolio, I am putting 25% into the SCHD. We put 25% into that VOO. And then we put the other 50% into the VUG and the QQQM, split 25% equally. Now, what that allows me to do is we have 50% of this portfolio in really the high risk, high reward, or the growth factor that we're going to have in here. Because even at my age, I probably have 20 plus years till the age of 65. If we push 67, 69, we might have 20 plus years of growth that we can get out of these growth ETFs in this portfolio. And again, looking at the dollar cost averaging, we do put money in here on a regular basis. Now, of course, the dividends earned, you can see right here, we've gotten $1,412 in dividends. Majority of those have come in as of recently because we restructured this a little while ago to include the SCHD, the VUG, and the QQQM. For a majority of time, I just had this literally into the VOO, and I felt like we needed some diversification in this portfolio, which is the reason exactly why we did build this out. Now you'll notice the market gain in 2.5 years is around $16,000 with a 57% return, which is kind of crazy to think of the return we're getting there. Of course, that is the inclusion of dividends. Now with the dividend portfolio and the way that M1 Finance works, I absolutely love it. You don't have to actually go back and rebalance your portfolio because as I'm adding money on this on a regular basis, it is essentially looking at here, we actually own the SEHD 25.1, QQQM 24.8. When I put more money in here, it is going to put more money into that QQQM, putting less into the SEHD, meaning this is going to auto balance based on contributions that I make. It is going to do the exact same thing. So if we're getting dividends, and even this quarter, I believe we got around $400 in dividends, getting the $400 in dividends is going right back into this portfolio. And again, looking as it sits today, $400 back into this portfolio, it would invest a majority of those funds into the QQQM, keeping this entire portfolio at our 25% objective, or the pies, that's what they call it at M1. So actually building this out and keeping it at a very set amount when it comes to the structure of the portfolio. Now, of course, this is going to be just a snowball. Once you start hitting the 100,000 mark, which is exactly what we did, when you start looking on a regular growth curve, even getting a 10% yield, it's going to grow faster and faster as we're seeing returns, as we're seeing dividends, as we're seeing growth in this portfolio, including we are continuing to put money in this portfolio as well every single couple weeks. And now we've actually went to every week or two. We continue to put more funds into this portfolio, meaning that we are going to build this even faster. So not only are we seeing the impact of the compounding interest, but overall, when we're starting to see the big snowball factor that we have within this portfolio, it is just going to continue to grow and continue to build this faster and faster. And as you can see, even when we go back we started this in around September 26th of 21. So now we're in 24. So we're looking September will be 3 years we've been invested in this portfolio. Already brought it up north of 100,000, and I cannot wait to see exactly where it grows in the next 3 to 5 years, especially with the contributions that we've been putting in here. So, all right, guys, that is going to do it for the breakdown of the 3 ETF portfolio. Let me know in the comments what you guys think, and as always, thank you guys for watching.